Hello Internet, and welcome back to the channel. My name is Alex, and as always, I'm here to discuss all things personal finance, and hopefully bring you some of the financial education that I never received growing up. With an extra week this month, I wanted to do a one-off video to discuss a fairly pressing topic, in fact, taxes. Coming from the US, I'm really only familiar with the system here, so I'll be focusing on that. Today, including the basics of how the system works, common misconceptions, and I'll use my own numbers to illustrate the concepts. Of course, all of this presented here is for entertainment purposes only. Please consult with a CPA, EA, or other tax professional prior to submitting your taxes. Don't just listen to some guy on YouTube, such as me. But although tax preparation can be pricey, usually I have found that they are well worth the investment, and they'll actually ensure your taxes not only are filed properly, they can actually usually find additional deductions or credits to more than offset the cost you're paying. Again, at least that's been my experience in the past. As this should be coming out the last week of April, it should be a pretty timely video. Although tax day is usually April 15th, in 2021, the IRS has extended the deadline for individual returns to May 17th. So, if you haven't completed your taxes yet this year for 2020, you very well may be in luck. But time is quickly running out. For those of you who have already filed, please let me know down in the comments whether you're getting a return. And if so, what are you planning to use it for? So how does the US tax system actually work? Well, the basics are pretty simple. The US uses a progressive tax system where the tax rates increase the more you earn. In marginal tax systems, the entirety of your income is not taxed at the top marginal rate. Rather, the income in each range is taxed at the marginal rate it falls into. Thus, while more income will increase your taxes, it's not as though the tax rates are thresholds which will cause your tax burden to jump if a raise or overtime causes you to cross it. Let's actually start with an example. Here's the federal tax tables for 2020. I'm not going to get too deep in the weeds on these, but let's say you're single with a taxable income of $80,000. As a single person, this puts you firmly within the 22% tax rate. However, that does not mean you would be paying $17,600 in taxes, or 22% of your income. Only the income above $40,125 is actually taxed at the 22% rate. So in this example, the first $9,875 would be taxed at 10%, for a total of $987.50. The income from $9,876 up to $40,125 is taxed at 12%. So we would then add an additional $3,630 as we clear this threshold. And to round out the $80,000, the remaining $39,875 we still have left is taxed at the 22% rate, which does add an additional $8,772.50, which brings the total to $13,390. Now, this is clearly still a tidy sum to simply be giving to the government, but it's $4,210 less than a 22% tax rate would imply. Thus, the effective tax rate for this individual is only 16.74%. If the same example was actually the combined income for a married couple who file a joint tax return, irrespective of how much each spouse individually earned towards this $80,000, the tax burden would actually substantially decrease down to just 11.5%, coming in at a total of $9,205, as the entirety of the income would be taxed at 12% or less. Of course, this is just to illustrate the point. Unfortunately, the actual tax system is significantly more complex with a lot of moving parts, including your federal income taxes, which we just discussed, FICA taxes for Social Security, Medicare, and Medicaid, state and local taxes, depending of course on where you live, and then different tax consideration depending on the type of income received. Honestly, this is a topic that can go way above my pay grade. But in a nutshell, ordinary income, the income you make from your W-2 or 1099 job, for salaried or hourly wages are all taxed based on the tables that I showed before. If you happen to be retired and drawing from traditional 401k accounts, those also receive this same tax treatment. Other types of income can qualify as capital gains and in the process gain favorable tax treatment, assuming that certain conditions are met. One such example is if you hold a share of stock for at least a year before selling it. Once you then sell it, any gain in value will qualify as long-term capital gains and are subject to a different set of federal taxes, the highest tax bracket of which is 20%, significantly lower than the 37% that we saw for those that had high ordinary income. It is largely because of this tax treatment of capital gains, along with a variety of deductions that we'll talk about next, that allow many of the wealthiest individuals in the country to pay a lower effective tax rate than their secretaries. However, it is also through keen understanding of these capital gains tax brackets that one can employ techniques such as the Roth conversion ladder to pay no or minimal taxes on retirement assets. I will do another video in the future discussing the subject as it is truly interesting, but a far more complicated topic than I want to get into here. Of course, we all want to pay the minimum amount of taxes that we can, legally of course, which is where the opportunities for deductions and tax credits come into play. Deductions are a variety of expenses allowed by the IRS that can decrease your taxable income and then include things such as mortgage interest, medical expenses, charitable donations, property taxes, state taxes, and a variety of other things. There are far too many here to go through the entire list. Alternatively, if these expenses are low, or if you don't have the necessary records, for example, you can just take the standard deduction with no questions asked. Now, in my opinion, one of the best aspects of the Tax Cuts and Jobs Act, the law that dictates our current tax system, is the increase in the standard deduction. For 2020, the standard deduction for an individual is $12,400, and for those like myself who are married filing jointly, it's $24,800. If you're filing as a head of household, it falls somewhere in between at $18,650. It's been estimated for around 90% of people, they will actually be better off taking the standard deduction than itemizing their deductions, which could save you significant time. However, if itemizing is actually better for you, you may as well do so rather than leaving money on the table. There are also deductions which can be taken in addition to the standard deduction in the form of income adjustments and include things such as traditional 401k, 403b, or IRA contributions, HSA contributions, and in 2020, up to $300 in charitable donations. In all cases, deductions do not reduce your taxes by the deducted amount, but rather reduce your taxable income by the amount you can deduct. On the other hand, tax credits are a dollar for dollar reduction in your tax burden, up to, and sometimes including, money returned to you if the credit exceeds your total taxes. I'm certainly no expert on all of the credits, but there are several, including the Earned Income Tax Credit, the Child and Dependent Tax Credit, Adoption Credit, and many others. These come in three flavors: non-refundable, refundable, or partially refundable. Non-refundable tax credits will reduce your tax bill to a maximum of $0, but no further. On the other hand, refundable tax credits are termed such because they will actually credit any remaining amount after your tax burden has been reduced to zero. So if you were to owe $1,000 in taxes, but have a $2,000 refundable credit, you will actually receive $1,000 and have to pay nothing in taxes. Partially refundable tax credits are somewhere in the middle, where not the entirety of the credit is refundable, but a portion of it is. One example of this is the child tax credit. Now, the rabbit hole here gets quite a lot deeper once we start considering business income, but most of you here are probably primarily normal W-2 employees, so let's just leave it there for now and keep things as firmly in my wheelhouse as we can. But let's put this together using my own family's taxes as an example. I'll be rounding some of the numbers to make my job just a little bit easier, but you'll get the general idea. But before we do, these videos actually take a lot of preparation, so please go ahead and smash the like button for the YouTube algorithm. But in 2020, my family's total gross earnings were $214,400, including my salaried wages and my wife's business income. Because we were filing jointly and our itemizations were to fall well short of the $24,800 standard deduction that we were entitled to, we simply took the standard deduction, which does drop our income down to $189,500. Because our income secured us with a top marginal tax rate of 24%, this deduction alone saved us nearly $6,000 in taxes. We were then able to make additional adjustments to our income of $11,000 for qualified deductions, including our HSA contributions, charity, a couple related to my wife's business, and so on. Altogether, this left us with a taxable income of $178,500. You'll notice here that I did not mention a tax deduction for a 401k or IRA contribution, and that is because we have opted currently to contribute fully to our Roth 401k, which does not provide this tax deduction. Rather, this account will grow tax-free. Additionally, at our level of income, we do not qualify for traditional IRA tax deductions. Overall, this left us with a $32,000 tax bill, including the self-employment taxes that my wife's small business had to pay. Despite finding ourselves in a 24% top marginal tax rate after our deductions and adjustments, our effective tax rate was only 14.9%. And thankfully, as large as that $32,000 figure is, it doesn't sting all that badly, as my company has simply been withholding these funds for our taxes throughout the entire year. So we've really been living as though those funds never existed, at least for us, in the first place. Even better, we actually get a small refund. A quick aside here, tax refund really just means that you've been overpaying all year. Essentially, you've been giving the government an interest-free loan. So that's obviously not something I want to be in the habit of doing. So we try to keep these refunds as small as possible, but we will get a couple of $1,000s this year, which is always welcomed. So there you have it, the US tax system in a nutshell. There is a ton of nuance in the individual rules, deductions, and so on, and I am not an expert in the subject matter. Again, I do implore all of you to check the IRS guidelines closely when preparing your taxes, or consider a tax expert or even tax software to help you to legally minimize your tax burden. They have always, to me at least, been well worth the expense. But with that, thanks for sticking with me to the end. Taxes are never fun and usually quite controversial. Nonetheless, I would love to hear from you your thoughts on the US tax system and where you see the tax rates going in the coming years. It'll certainly be interesting to look back in a couple decades to see how right or wrong we were. If you haven't already, be sure to smash the like button and hit the subscribe icon down below. If you then ring the bell, you'll be notified each time we post a new video. I'm still posting twice a week on personal finance, investing, and retirement, as well as videos like this where I track my own family's progress as we pursue financial independence. I hope you'll come along for the ride. With that, I'll see you in the next one.